Okay. Thank you. First, thank you to Jim and Avner for inviting me to participate, as well as Jenny and all the conference organizers for putting on another great event. Daniel did a great job describing the paper and the thrust of what he did, so I'll try to be brief in giving an overview of his study. The question Daniel's asking, the economic question, is how do control rights affect security pricing and claimant value, notably debt and equity? And in many ways, this is the perfect complement with an I and an E, to Peter and Giguo's paper, because this paper is entirely about commitment. He's going to look at how restrictions in the form of covenants shape ex-ante incentives, corporate behavior, and value. And the motivation is large. I'll touch on some of the theory a little bit later, briefly. Empirically, there's been a lot of work that I'll classify as ex post. There's been a bunch of studies that look at how control right transfers from equity holders to creditors resulting from covenant violations impact corporate policies. And what we see is significant changes in investment policy, financial policy, governance, labor, and others. What we haven't been able to show or identify is how do these future control right allocations affect ex-ante incentives and corporate behavior, what I'll refer to as ex-ante. And the reason why is simple. It's just hard. Contracts arise in equilibrium from bilateral and multilateral negotiations. There's no sense of exogeneity anywhere, and so the literature is largely punted on the issue. And this is where Daniel's paper steps in. He's going to look at bond refinancing behavior as firms move across the investment-grade junk divide. Right? And the idea is he's going to exploit these sharp differences in the contracts of investment-grade firms which have few or no covenants, and junk firms which are just loaded up with covenants or restrictions. Okay? And if covenants are costly, what's going to happen is as firms move across this divide and want to take advantage of interest rate changes to refi their debt, the change in the covenant structure should affect that refinancing behavior. Okay? That's the intuition for this paper. And in fact, that's exactly what he finds. What he sees is fallen angels. As you move from investment grade to junk, they wait a really long time or wait for interest rates to move by much more than otherwise junk firms do, because they know as soon as they refi the debt, they're going to be encumbered by restrictions. Okay. The exact opposite happens with rising stars. And so what happens is that I move from junk to investment grade, I'm really anxious to refinance my debt because I get rid of all these covenants. And sure enough, I see only a 100 basis point decline as opposed to a 220 basis point decline across these two categories of firms, if you will. But Daniel doesn't stop there. He then goes on and looks at the value effects of covenants and tries to quantify the implications for debt and equity. And what he shows is a range of different values, but ultimately plausible, but pretty large effects for what he calls the agency costs of debt. All right. This is an interesting and clever paper. It's tackling a really hard and important problem, and it's doing so in a novel way. I actually quite enjoyed reading this paper, which I haven't said in a while. The remainder of my time, I'm going to touch on the three parts of this paper, the theory, the empirical interest rate effects, and the value effects. So I'm going to spend most of my time on the middle, because I think that's where this paper is strongest and really has the most potential to have the largest impact. So let me talk about the theory in one slide. Okay. I don't see the point of this, not because there's anything wrong with the theory, okay, or that I didn't understand it, but I just wasn't sure after reading the theory section what I learned that I couldn't learn from all the studies that explicitly look at covenants, or the monstrous literature on incomplete contracting focused exclusively on financial contracts. If there's something novel here, go ahead and highlight it, make it more prominent. Otherwise, just jettison it. If you're really attached to it, chuck it in an appendix. All right. Part of this is motivated because I want more space to understand the data and the empirics, because I think that's where the real bang for of this paper comes from. So on the plane ride over, I just did a quick and dirty replication of the study. And so I yanked all the FISD data off of Words. And if you see differences in my numbers and Daniel's, don't misinterpret that as anything Daniel's done wrong. More likely what's happened is I was sitting between my 7-year-old son and 8-year-old daughter who don't know how to get along yet, and this is quite noisy. But what I want to know is Daniel's honed in on 6 covenants here, just for descriptive purposes, but that's 6 of 20. And actually, there's quite a few more that I just couldn't fit on the screen. So how did you choose to focus on these covenants? What's special about them? Second, one thing I found a little bit odd, you show that investment-grade debt has absolutely no restrictions on asset disposition. So the firm can just sell off divisions, assets at will, okay? But when I looked at the data, and again, subject to the caveat this was quick and dirty, I found almost 80% of the investment-grade debt just said, hey, you can't just be selling off divisions wholesale. That's a no-no even for relatively safe people. So I'm not sure if that was because I got the clause wrong, whether you were actually looking at an asset sweep. But again, I think more time spent on the data would help sort of flesh out some of this confusion on the reader's part. Now, remember in Daniel's paper, the null hypothesis is that when I refi my bond, I look at my interest rate savings and I pull the trigger assuming they swamp any transaction costs and option value to weighting because the interest rate could go down further. Okay? The alternative is I have to also now consider the restrictions imposed or relaxed by changes in the covenant structure of the new contract. Okay. I actually think there are more alternatives than just that. If you look at this picture and you see this kind of discontinuity, it's not because BBB minus firms are so radically different in credit risks from BB plus. It's because, and Daniel notes this, it's because these are 2 totally different capital markets, the high yield credit market and the investment grade market, with completely different investors, right? I mean, you've got hedge funds and all sorts of finance companies out here. These are insurance companies and pension funds. And so one thing that I think needs to be considered are the market conditions around the time that firms are transferring from either investment grade to junk or vice versa. So some alternative interpretations that sort of immediately came to mind was, one, are fallen angels waiting longer because it's just harder to place high yield debt? The market's more cyclical, investors are less liquid, fallen stars happen outside, but fallen angels tend to happen in down markets when credit conditions dry up and, well, you have to actually sell the debt to someone even if you want to sell it. Okay. All right. Are interest rate movements simply larger for fallen angels because interest rates are moving down in down markets more quickly than they are in other market conditions? In other words, is the option value of weighting different across different phases of the market when we will see rising stars versus falling angels? I would suspect so. Okay. And so what I'm really asking for here is it'd be helpful to have some evidence just on the timing of these transitions vis-a-vis the interest rate environment, as well as some measure of something to capture the demand. And you can look at relative credit spreads, which is obviously an equilibrium concept tainted by supply, but I want to know what's going on in the demand. All right. Think about the story here. I'm a fallen angel. I was investment grade. I had this great deal. I could do anything I wanted. Now I'm junk. But I still have the great deal. So are fallen angels actually knowing that when they refi, they can't do anything, doing something now? Are they accelerating investment? Are they paying out distributions to shareholders? Are they issuing additional debt knowing that as soon as they refi, they won't be able to do any of this? You would think there would be some incentive to accelerate a lot of these decisions. So you can look at that. You can actually look at that in the data. And what's great is if there's any heterogeneity in those incentives to respond, you can actually exploit it to identify expropriation. Because if I start accelerating all my investment to expropriate my debt holders, that debt value should collapse and equity should go up. So you can get additional variation to identify the effects you're trying to get at. Now, that said, this isn't new. Why don't debt holders see this potential for credit deterioration? Right? If you go back to the 80s and the corporate restructurings, we had a whole bunch of fallen angels for the first time, and as a result, event risk covenants came on in droves. right? And I don't just mean changes of control, I mean credit rating triggers, right? So if your credit rating fell, right, boom, that's an event of default for the bond. And so are event risk covenants really that absent from investment grade debt? I'm a little bit surprised, not for Microsoft or an Apple that's collateralized their debt with 10 times cash, but for actual potential fallen angels. And then coming back to something Bo mentioned in his discussion, right? Remember, and actually Daniel touched on, you can't look at these bonds in isolation, because if you go back to that data I showed you, over 70% have a cross-acceleration provision. So the instant something gets bad enough for another bond issue, including the bank, to say, I don't like what's happening, you need to start repaying us, boom, you got to repay the bond. Which is exactly why banks rarely, if ever, declare default, because they know the instant they do, all the debt comes through. Okay. And I don't like that thing, so let's ignore it. Okay, good. All right. Now, the value implications is the second half of, or the last third of the paper, I should say. Think about what you would do from a naive reduced form approach. Here's what I'll do. I'm going to look at fallen angel firms and rising stars, and I'm going to look at how their debt and equity values change as they move from investment grade to junk or vice versa. And I'm going to say, aha, those changes in value represent the value of covenants. Okay. Or maybe I could do something slightly less naive and set up a control group, such as comparing fallen angels to always junk. But ultimately, it's particularly naive. Why? Because when firms move across the divide, there's so many value-relevant facets of the company that are changing. Actually disentangling them empirically is really, really hard. And so you can imagine if I got up here and ran a regression of equity value on a change from investment grade to junk and a whole bunch of controls, I'd have Tony yelling at me for about measurement error and market to book, and the new chief of identification police, Jonathan, over there, would walk out. Right? Okay. So, I mean, this is a really hard problem. Okay? So what does Daniel do? He's going to apply a structural model. What he's going to do is he's going to set up the firm's a cash machine funded by debt and equity that exogenously disappears with some probability. Okay? He's going to exogenously impose covenants that restrict or affect the asset return distribution of the cash generating machine, as well as the likelihood of disappearing, And so the firm's problem is, I just got to figure out how to refinance this debt to trade off the benefit of of interest savings with shedding covenants. Okay. My question is this really a solution? It seems to me that you've just assumed away all the problems that I've identified and restricted all the value variation to move through interest rates or covenants. There's no way for them to be sopped up by other controls in a regression if you were thinking in terms of reduced form. And so maybe it's just me, but I view the endogeneity problem not as a modeling problem, but as a data problem. Right? That's what we learned from the Rubin causal model framework. Right? The counterfactual is a missing data problem. We just don't observe it. And so typically that's solved by data, not necessarily models. Right? So I'm a little bit more suspicious of the value estimates given the environment you have to believe to take them at face value. So, in conclusion, all right, I believe the message. And some of the criticisms I had doesn't take away from the cleverness of this paper. I think the impact on corporate behavior is new and interesting, and with a little bit more additional evidence in that direction, is only going to make what is already a good paper even better. So, thank you very much for your time.